The main event influencing market sentiment was the Fed's rate cut decision. Prior to the announcement, markets had been divided on whether the cut would be 25 or 50 basis points, as tracked by the CME FedWatch tool. The Fed's decision to implement a more substantial 50-point cut, the first since March 2020, initially caused a muted reaction, with the S&P 500 closing slightly lower on Wednesday. Historically, initial market declines following the start of a Fed rate cut cycle are not uncommon. However, by Thursday, the markets responded enthusiastically, with the Dow, S&P 500, and NASDAQ all rallying to new highs. U.S. retail sales rose slightly in August, surpassing economists' expectations of a minor decline. Sales increased by 0.1%, and July's gain was revised up to 1.1% from the initially reported 1%. A widely watched bond market indicator, often used to predict recessions, also eased concerns about an economic downturn. Since mid-2022, the yield on the 2-year Treasury had exceeded the 10-year yield, creating a yield curve inversion, a signal historically associated with recessions. However, on September 4th, the 2-year yield dipped below the 10-year yield, where it remained by Friday's close, with the 2-year at 3.58% and the 10-year at 3.73%. A report set for release on Friday will reveal if inflationary pressures continue to ease in August. The latest available data showed that in July, the Personal Consumption Expenditures Price Index, excluding food and energy, rose by 2.6% annually. Large-cap indexes reached record highs, driven by optimism over a potential prolonged cycle of Fed rate cuts. The rally was broad, with smaller-cap stocks outperforming, though they remained below previous peaks. The small-cap Russell 2000, for example, ended the week about 9% off its record high from November 2021. Consumers appear to remain in a strong position, based on the week's economic data. On Tuesday, the Commerce Department reported a 0.1% rise in retail sales for August, surpassing expectations and following July's upwardly revised 1.1% increase. Further positive news came on Thursday, when weekly jobless claims fell unexpectedly and continuing claims dropped to their lowest in 3 months. Investors were also heartened by signs of improvement in the struggling housing market. The Commerce Department reported a 4.9% increase in building permits in August, the largest monthly gain in a year, bringing them to their highest level since March. However, on Thursday, the National Association of Home Builders revealed that sales of existing homes had unexpectedly dropped by 2.5% in August. In the bond market, the yield on the 10-year Treasury rose modestly after the Fed's rate cut, briefly hitting its highest level since September 5. Tax-exempt municipal bond yields also declined earlier in the week due to abundant cash and a light issuance calendar, though they edged higher on Thursday as the Treasury yield curve steepened post-Fed decision. Corporate bond markets showed strong demand early in the week, with tighter spreads in the investment-grade space and oversubscribed issuance ahead of the Fed meeting. High-yield bonds traded flat before the Fed's announcement but strengthened later, buoyed by heightened trading volumes and a general shift toward risk-on sentiment after the rate cut. This backdrop supported new issuances, and several deals were announced.